Hi, I'm David Stein of Money for the Rest of Us, and in this video, I share with you how to invest in the VIX Volatility Index, and should you? So what is this VIX, this Volatility Index? This is a measure put together by the Chicago Board of Exchange, and it's a measure of the implied volatility. How much is the stock market going up and down, investors' expectations over the next 30 days. They calculate this measure based on the pricing of S&P 500 stock options. So a stock option, when you buy that, gives you the right but not the obligation to purchase an asset. And during periods when the market is more volatile, when there's more ups and downs, the pricing of these stock options tends to be higher. Because if something's more volatile, it's more likely to hit the strike price, the price that you can buy the option at. And so what happens is during a market sell-off, the implied volatility as measured by VIX tends to spike. And so investors like to invest in VIX as a way to hedge their portfolio because their VIX exposure is going up in value at the same time the stock market is going down. Now, one of the challenges is how do we actually invest in VIX? Typically, you can do it through, or historically through, a futures contracts. There are VIX futures. There's options on the VIX. And now there are exchange-traded funds that invest in VIX. An example is the ProShares VIX Short-Term Futures ETF. And that is an exchange-traded fund that is investing in the shortest or the closest contract, because the way that VIX works is you buy a futures contract. So I'm recording this in September 28. The next futures contract is the October 2018 VIX future. Now here's the challenge. We can't go out and buy what's known as spot VIX. What is VIX today? Investors' expectation of VIX or volatility over the next 30 days. That's at 11.68. The exchange-traded funds, or us as individual investors, if we want to get exposure to VIX, we have to buy that October VIX future contract, which is priced at around 14.3. So it's much higher than the spot VIX. If we want to get exposure to the November contract, that's at 15.1, and December is at 15.4. So it's an upward sloping curve. That's what's known as contango. And this is why there's a challenge in investing in VIX. If I buy that October VIX future contract, in order to make money, the spot VIX, which is at 11.7 right now, needs to be above 14.3 30 days from now. And who knows if it will be above 14.3. But when you invest in this short-term futures or VIX futures ETF, it is rolling over that contract every month. So when this October contract expires, it buys a November contract and then the December contract. And the prospectus for this ETF says this is a short-term investment and you need to monitor it daily. Why is that? Well, because they're rolling over that contract every month, that means if VIX just stays the same, they're losing money every single month. Now, this particular ETF in the first quarter of 2018 was up 69% because VIX spiked dramatically during the first quarter. But year to date, the ETF is still down 5%. It's down 23% over the past 3 months because volatility has sort of been more stable, and that ETFs loses money every single month as it rolls over that contract because of that upward sloping VIX curve. If we look at the longer term performance of this VIX short-term future ETF by ProShares, it has lost 58% annualized over the past 3 years and 50% annualized over the past 5 years. You wouldn't make money investing in VIX that way. Now, if you invested in VIX futures, short term, you would have had the same problem. And surprisingly, there's actually leveraged versions of these VIX ETFs. So they're very, very short term plays. Do I think volatility will spike in the next 30 days? That's sort of the bet you're making when you invest in either the VIX futures or a VIX ETF. Who knows? Essentially, you're guessing. There is no way to get an informational insight to say that VIX will jump in price, the volatility will spike in the next 30 days. Ideally, if VIX wasn't in contango, we could actually just own these VIX ETFs and benefit from when volatility spiked and makes money. But because we're essentially competing against other investors and their expectations of volatility in the future, they believe volatility in futures, generally they believe it's going to be higher than it is today because that's what they're protecting against. And again, this volatility is based on the pricing of US stock options and what investors expect. So I don't invest or hedge with VIX futures or ETFs because I don't have any insight over what's going to happen over the next 30 days. Instead, I adjust my overall allocation to stocks and other risk assets based on investment conditions. What's the risk of a recession? How high are valuations? What's the level of fear and greed? I find that's an easier way to do it because I don't have to make that many changes and I'm not losing money every single month with exposure to the VIX Volatility Index. So hey, if you have any questions on this video, go ahead and leave those in the comments. Thanks.